Good evening, dividend investors. So today I'm going to talk to you guys about what stocks that I purchased and how much I purchased of it in the month of August. Now, I guess to start us off with the video, I normally like to talk about where my current portfolio is at. So at the moment, we're around 300 or so $1,000, of which $214,000 is in the dividend growth aspect of the portfolio that I always talk about. Current yield in the portfolio is around 4.9% for a forward income of around $10,500. That ends up being about $875 a month if I were to average this out and divide it by 12. Now, specifically talking about August, I broke it out for you guys. So purchased around $15,000 worth of stocks. Now, a lot of that was, generally speaking, this is an abnormally high month for me just because of the fact that I sold a car and, moved outside the country and things along those lines. So there were some funds associated with being able to sell some things and what have you. So yeah, just self-explanatory. This isn't a normal month. Normally, it's about a third of this is what I'm actually able to invest. So this was an abnormal month. It doesn't include 401k contributions or anything like that. But this is strictly things along the lines of what's going into my YouTube account, my individual brokerage account, my M1 Finance, and Fundrise accounts. So hopefully that is a little bit of a disclaimer and helps you guys out with understanding, this isn't typical, slightly above average month for me. So specifically looking into what I purchased. So I purchased 2 shares of IVV in my YouTube Moolah account. For those of you that don't necessarily know what IVV is, and we'll get to Fundrise in a minute, IVV is the iShares Core S&P 500. So it's kind of like the SPY, or I forget what Vanguard's is, but basically it's typical blend of growth and value S&P 500 funds. And so within my YouTube Moolah account, I just, whenever I get paid by YouTube or Google in this case, I take that money and I wait until I get enough to purchase shares of the S&P 500, just because really curious about if I'm actually able to beat the market or what have you. So it's kind of like not a hedge, but kind of like a mental tracker for me. So I can't lose by investing in the S&P 500, especially if I do it consistently and continue to make decent income through YouTube. So my thought is understanding whether or not, I'm completely making a mistake with doing my dividend growth portfolio, or if I should invest in the S&P 500. I've talked in the past about how I sacrifice 1 or 2% a year because I get enjoyment out of individual stock purchases rather than just investing in the S&P 500. But this is kind of allowing me to kind of play both parts. So going back to what I've actually purchased, a little bit late last week, I purchased around $5,000 worth of Altria Group, ticker symbol MO, in my individual brokerage account. That was good for about 110 shares. And if I remember correctly, I think it pays about 84 cents per quarter. So multiply that by 4 times 104 shares. So that was a good increase by about 300 or so, 369 or so dollars for an increase in income. For those of you that don't know necessarily about Altria Group, it is the one of the spin-off companies of Philip Morris. So it's the national U.S. portion that sells Marlboro cigarettes, smokeless tobaccos like Skoal, I believe. And they also have a 10% investment in AB InBev, Anheuser-Busch InBev. And so part of their income comes from that. And I believe they also own Nat Sherman cigars, and they also own, let me think, Chateau wine brands or something along those lines. So they own a decent wine portfolio as well. So yeah, somewhat diversified in the vices category. So if anybody's interested in earning some of those dividends from this company, look into them. They're currently around a 7% or so dividend. 3.36 cents per, or $3.36 a year, and that's good for about 7.5% dividend yield. Generally speaking, that's very atypical of this stock. The stock is throwing off cash like crazy, so I don't think that this company will have any problems being able to continue to meet the actual dividend payment obligation, but some of you guys might think otherwise. So anyway, going back and looking at Bryn Mawr Trust Corp., which is Bryn Mawr Bank basically. It's a small regional bank just outside of Philadelphia. Specifically been in business since the 1800s. Trying to think of any other real items that might come to mind here, but really small regional bank. I grew up around where this bank is located, and so the reason why I invested in it is because someone in my family used to use this bank, and I knew of only one branch. And then over the years, as I've traveled from Houston back to home around the Philadelphia area, I noticed more and more of these branches popping up. And so I looked at the actual ticker symbol, and over the past 5 years or so, it grew a little bit, and it seems like they've kind of taken a different route and approach with their typical banking. So they went more from like a conventional bank, which was strictly doing loans, to more of like a wealth management. And so now they have a couple $1 billion under management, and that part of their business is doing really, really well. They're continuing to expand into multiple different locations across a pretty prolific part of the Philadelphia area. So to me, that seemed like a company that, one, was doing really, really well, able to grow the dividend at a pretty decent rate, and then also a potential buyout target. Not necessarily hoping that they get bought out, but I think it might be a good consolation prize. And if they do get bought out, I probably would sell my shares and probably purchase something else, depending on what bank picks it up. But that is what it is. Maybe I would keep it as it is, but this puts me at around 200 or so shares of Bryn Mawr Trust Bank, which is a pretty decent amount. There's only 20 million shares outstanding for the company. So in that respect, I'm pretty excited. I own a pretty decent chunk, probably one of my biggest ownership positions in terms of the total company percentage ownership. It's about 0.01%. So in that respect, or is it maybe 0.001%? But regardless, very happy about it, and continue to reinvest the dividends here as I see fit, and hoping to grow with the organization. Going back to the M1 Finance purchases that I just demonstrated not too long ago, about 17 shares of 3M and about 21 shares of Johnson & Johnson. The reason why I'm saying about is because those actually, although I submitted the order for them in August, they won't actually get bought until Tuesday, the 3rd, for about $5,500 in total, split between the two using M1 Finance. So I put 50% in 3M and 50% in Johnson & Johnson. And it just so happens that that is the way that they come out. Now, actual yield on this, or actual increase in the portfolio, let's just do a quick check here. So for 3M, that would get me around, $97 increase. And then for Johnson & Johnson, that would get me, I forget, what is it, 90 or 95? It is what it is. Another $81. So between these two, it gets me around $179 in dividends. Sorry, got these pop-ups here. So around $179 in dividends, and that is off of $5,500 investment. So $5,500, or whoops, sorry, $179 divided by $5,500. It's an average of about 3.2% yield, which is pretty good. But overall, I think this is heavily offset by the yield in Altria Group, and I believe Bryn Mawr Trust yields anywhere between 2.5% to 3%, if I remember correctly. We can check it out really quickly. So that is also offsetting part of the Altria Group dividend yield as well. So dividend yield currently on Bryn Mawr Trust is 3%. Yield on cost on that is about 2.8%, and total income from that is about $200 a year. And what's my Johnson & Johnson up to? 3M's up to about 175, and my Johnson & Johnson is up to about $95 in terms of total income. I thought it'd be more than that. I haven't added in the about 17 and about 31 shares. Okay, so I still technically need to add in the Johnson & Johnson and 3M. So that'll be another $100 or so that I need to add in to the portfolio because I have not added those in yet because I didn't know how much exactly to add. So I'll wait until it actually gets executed, and then I can worry about that. So for those of you guys that don't necessarily know what 3M is, it is not specifically this one. Concentrate on the 3M company here on the left. We're not talking about the Russian Ponzi scheme, which I didn't even know that showed up until I just saw that there. But 3M makes things like Post-it notes. PPCEN is a big advocate for this company. A lot of people are a big advocate for this company because the earnings have slipped slightly, but the revenue has gone down 1 or 2% over the past year or two. So the share price has dropped from about $280 a share or $250 a share from its maximum down to over 160, and sometimes even dipping into the 150s. So you can pick it up for a pretty big discount. That's over 30 to 40% around there. So in that respect, that has let the dividend yield climb to about 3.5% or so. All the while, the stock and company is in relatively good shape. So yeah, there's that. And for those of you who don't know Johnson & Johnson, Johnson & Johnson is a pharmaceutical medical device company, and they also make things like Band-Aids and what have you. So I actually purchased Johnson & Johnson a few years ago when it was back around $95 or $95. I'm sorry, not $25. $95, and then once it got into like the 120s or something, I sold. So I guess good on me because I did sell it and I was able to purchase something else. I don't know exactly what I purchased, and I purchased around $130, $125 a share over the past couple months, and so I didn't necessarily lose out too much on my purchase at about $95, $96. I believe it was somewhere in this range when I purchased it, and then sold it again once it got to the 120 range. So I lost about $5 a share, maybe $10 a share, but I was actually able to use that money elsewhere and build the portfolio up a little bit more. And now with these recent dips from the 140s range down to the 120, 130 range, I've purchased it back. It might be at a slightly less favorable price to earnings ratio, but I believe Johnson & Johnson is a high quality company, and they'll continue to raise the dividend pretty drastically over the coming years. So I'd rather purchase a company that I know will be stable and potentially lose out on growth than a company that might have high growth and be less stable, if that makes sense. So definitely something needed for the portfolio, something that I needed to boost up my healthcare position in the portfolio, because at the moment my healthcare position is really, 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 really small comparatively to other things like real estate, financials, and my energy position. And last but not least, I have my Fundrise, where I added about $137 or so to that. And for those of you, I don't know if I've necessarily made a video about that, but some other YouTubers kind of got me, I guess, inspired to invest back into my Fundrise portfolio. Some folks were really adamant about it, and I know I've talked pretty negatively about the platform as a whole in the past about its total returns compared to what I was, say, promised. But that being said, I believe that this is a good way to diversify and it's only 100 or so, 30. It's 130, $140 a month that I'm now investing. So in the grand scheme of things, it's a relatively small portion of the total value that I'm investing on a month-over-month basis. I could be more aggressive, to be honest, if I wanted to be, but I believe that I personally like the dividend investing route rather than the Fundrise route. Although I do really enjoy Fundrise's user interface and the cool understanding of the projects. If I do too much real estate investing other than real estate investment trusts, I personally would like to invest it in actual real estate. So at this point, real estate is getting to be a pretty big part of my position, total dividend portfolio position. And part of me quite often, it's this 15.8% here, part of me quite often really thinks about selling off a portion of this and using that money to then purchase actual physical real estate. So I believe it was last year or earlier this year where I kind of did an arbitrage of investing in, say, I believe it was Realty Income Corp. At one point I had about 250 shares of Realty Income Corp, which was paying me relatively well. And then there was an opportunity to sell that and get into Grant Cardone Capital. And so I took that opportunity, and I believe that the income that I'm getting from that is, I would say, about 60 to 70% more than I would be getting from my Realty Income shares. But I need to do the exact math on that, so don't quote me on that one yet before I do my exact math. But yeah, that's relatively it. So I really hope you guys enjoyed this particular video about the stocks that I purchased in August. If you have any questions, comments, please feel free to leave them down in the comment section down below. If you have any questions about the spreadsheet or anything like that, I've made an instructional video for you guys, and I'll leave that in the comment section down below as well. If you'd like to purchase the spreadsheet, I'll leave a link in the comment section down below as well, or not comment section, but the description box down below. And if you haven't already, please like and subscribe. It really helps me out to grow the channel and help influence others to change their mindset about dividend investing. Once again, I'm not necessarily, but I am not a financial advisor, so please take this as my personal journey and not necessarily advice for you to purchase any of these stocks. I am long all these stocks as a disclosure, and yes, I believe that is it. Yeah. Okay. Thanks, you guys. Hope you had a great weekend, and I hope you have a phenomenal Labor Day as well. Have a good evening.